Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner, with our November monthly market update. Before I begin, I want to thank our clients for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. So a couple of events to make you aware of. We're looking forward to seeing many of you at our curbside event. Last year, we had over 100 participate. We're giving away tamales and other refreshments, and also supporting a local food pantry through Cypress Assistance Ministries. You've received an invitation to that already, so hopefully we see many of you there. We're also, as a team, participating in Wreaths Across America the next Saturday, December the 16th. Our team is going to be laying wreaths at headstones here in Houston, and we've asked for those clients that have served or have a family member that served to share that information, and we'll be donating a wreath for every one of those mentioned. So we very much look forward to honoring those that have served our country. So a lot of headlines going on just this past week. These are some of the headlines the markets are responding to. Everything from Moody downgrading the U.S. debt to the Fed both pausing in terms of rates, but saying rate hikes are on the table if necessary. Consumer alert. This is a interesting stat that we've talked about a lot, that after record excess savings in COVID that peaked in August of 2021 at 2 trillion, that excess savings is now down to 148 billion. We've got car owners falling behind on payments at the highest rate on record, and credit card debt hitting an all-time record of just over $1 trillion. So those are just the headlines from just this past week. So clearly a lot going on. Let's talk a little bit about markets. August, September, and October were bad months in the markets. In fact, the first time in history that bonds have lost money in 6 consecutive months. That's due to, of course, to rates going up. And when rates go up, bond prices go down. On the stock and bond side, it's only the second time in history that stocks and bonds have both been down for 3 consecutive months, and they were August, September, and October. Now, in November, markets have started to improve. We've also continued to see this very narrowness of market performance, with the top 7 stocks being up a lot. And by the time you get to the 100th to 500th, the market cap being negative. So there's still a very narrow concentration in what's been referred to as the Magnificent Seven, mainly tech stocks. And what that's resulted in is the price of the S&P 500 is pretty expensive. So the top 10 are trading at 143% of their current average. Also, as it relates to market cap versus earnings contributions, those are out of symmetry, if you will. So while the top 10 of the S&P 500 have 33% as it relates to market cap, they're only contributing 20% of earnings contribution. So that's something to keep an eye on. We are, as we turn the page into November and December, in the best period of time. If we look at the difference between May to October versus November 1 to April 30th, since 1926, the yellow bar is where we are. So that's overall supportive of this period that starts November 1 through the end of April. The Fed did pause after raising rates to the highest level in 22 years. So we sit now at about 5.5%. We've likely, at least for now, unless conditions change, we're in the pause stage, meaning rates won't go up or down, but they'll stay where they are for a period of time. Now, this has real world impacts in terms of rates going up so high. Mortgage rates have surged. In fact, we see that in 2023, housing affordability is at its lowest point since the late 80s. So real world consequence as it relates to borrowers of money, whether that's an individual or a company or the government. Now, we're in this pause mode where the S&P is likely, again, not to raise or cut for a period of time. And what we see is in different asset types, mainly stocks and bonds, pretty good performance during periods of time between last hike and first cut. We also see, this is another way of looking at that kind of same data point, returns following the last interest rate hike on a 12-month basis, stocks and bonds, both pretty supportive overall. And the average length of time from last raise to first cut is about 10.5 months. So the October jobs report was kind of a Goldilocks number, meaning it wasn't too hot. That suggests the Fed had more to do, but it was also modestly higher. Unemployment rate stayed just under 4%. You had wage growth at up just about 4%. So overall, a good jobs report recently, and that it wasn't too hot or too cold. As it relates to the overall economy, the last read on Q4 or annualized GDP in Q3 was just under 5%. So that's pretty strong. However, the consumer is showing some signs of weakness. We talked about that on one of the front slides. What this shows is a little bit more detail here, meaning these are delinquencies of greater than 30 days in auto, credit card, and student loans. And you're seeing those start to pick up specifically in auto and credit card. And you see overall debt service ratio after being down has started to go up. So this is what households are spending to service their debt overall. And with rates being higher, that's picking up. So as we look at this, inflation did moderate recently. So we actually had an October where there was no price increase. And CPI is coming down just under 4%. Now you can view that in two ways. Number one, we're a lot lower than we were back in the summer of 22, but we're also a long way away from the Fed's target of 2%. If you look at markets after peak inflation, which again, the most recent peak we can mark at June. If you look at the next 12 months, historically, if you look at averages, the next 12 months are pretty supportive of stocks and less supportive of bonds. So as it relates to earnings, as of this point, 92% of S&P 500 companies have reported. 82% beat profit estimates, and about half beat sales. And so this earnings kind of recession that we went through in Q4 of 22 and the first 2 quarters of 2023 appear to be over. So after these 3 declines, now estimates are moving up. So overall, from an earnings standpoint, on the S&P 500, are pretty good so far this quarter. So none of this is an excuse to contact us. You know, we hope these monthly market updates give you some idea of what's going on in the markets, but we encourage you to reach out to us if you have any questions or want to discuss how all of these things apply to you specifically. We wish you and your families a very happy and safe Thanksgiving. We're very thankful for you, our valued clients, and look forward to seeing you in the very near future. Until we see you again, happy Thanksgiving, be well, and take care.